A 760 credit score and a 680 credit score applying for the same $350,000 mortgage are not getting the same interest rate. In 2024, the difference between those scores can be 0.5 to 1.0 percentage points on a 30-year loan. On $350,000, that's an additional $90,000 to $180,000 paid over the life of the loan. One number, one decision, or series of decisions made years before you bought the house. Your credit score is one of the most financially consequential numbers in your life, and most people don't really understand what moves it. The FICO score runs from 300 to 850. Most lenders use it. It was created by the Fair Isaac Corporation and is the most widely used credit scoring model. VantageScore is a competing model used by some free credit monitoring services. It's similar but not identical to FICO, and lenders rarely use it for major lending decisions. When you care about your credit score for a mortgage, car loan, or apartment, assume your lender will pull a FICO score. The score your credit card app shows you may be a VantageScore approximation. FICO is built from 5 factors with specific weights. Payment history, 35%. Credit utilization, 30%. Length of credit history, 15%. Credit mix, 10%. New credit inquiries, 10%. These weights aren't equal. Payment history and utilization together control 65% of your score. Everything else is secondary. If you focus on those 2 factors first and get them right, you've done most of the work. The other 3 are refinements. Know where the leverage is before you try to optimize everything at once. Payment history, 35%, is binary and brutal. Every on-time payment is invisible to your score. It simply means your score isn't hurt by this factor. Every missed payment is catastrophic. A single 30-day late payment can drop your score 60 to 110 points depending on your starting score and credit profile. The higher your score before the miss, the bigger the drop. A 780 score drops more than a 620 from the same late payment. Late payments stay on your credit report for 7 years. The single most important rule in credit: never miss a payment. Set up autopay for at least the minimum on every account. Credit utilization, 30%, is the ratio of your current credit card balances to your total credit limits. If your combined credit limit is $10,000 and you carry a $3,500 balance, your utilization is 35%. Most scoring guides recommend staying below 30%. For excellent scores, stay below 10%. The calculation is per card and aggregate. A card maxed at 100% hurts your score even if your overall utilization is low. Utilization is also highly responsive. Pay down a balance this month, and your score can jump significantly by next month's reporting cycle. It's one of the fastest moving factors. Credit utilization myth: carrying a balance helps your score. This is wrong, completely and demonstrably wrong. Your score does not benefit from carrying a balance and paying interest. The utilization factor measures your balance relative to limit at reporting date, typically when your statement closes. Paying your balance in full before that date results in low or zero utilization and has no interest cost. Paying the minimum and carrying a balance gives you the same or worse utilization and costs you interest money. This myth benefits credit card companies, not cardholders. Length of credit history, 15%, rewards age. FICO considers the age of your oldest account, the age of your newest account, and the average age of all accounts. This is why closing old credit cards is often a bad idea. It removes the account from your average age calculation and can reduce your oldest account age if it was your oldest card. Keep your oldest credit card open even if you don't use it. Charge one small subscription to it annually and pay it immediately to keep it active and prevent closure for inactivity. Credit mix, 10%, rewards variety. Lenders like to see that you can manage different types of credit, revolving accounts like credit cards, and installment loans like auto loans, student loans, or mortgages. Having only credit cards or only loans limits this factor. You don't need to take on unnecessary debt to improve your mix, but if you're already managing a mix of credit types, understand that it contributes positively to your score. Don't close installment loan accounts early just because you can. Let them age on your report. Hard inquiries, the new credit factor at 10%, occur when a lender checks your credit to make a lending decision. Each hard inquiry typically drops your score by 3 to 10 points and remains on your report for 2 years, though the scoring impact fades after about 1 year. Soft inquiries, checking your own score, employer checks, pre-approval offers don't affect your score at all. Shopping for mortgage, auto, or student loan rates within a 14 to 45-day window counts as a single inquiry under FICO scoring rules, so rate shopping doesn't compound the impact. You now know what drives your credit score, all 5 factors, their weights, and how each one actually works. In part 2 of this series, I cover the specific tactics to raise your score in 90 days. The exact moves that produce the fastest results if you're preparing for a major purchase or need to repair credit damage. That video is next. And if you want to understand how a higher credit score helps you in specific contexts, like mortgages and car loans, check out my video on hidden home ownership costs for the full picture.